Okay, well, good morning, everyone. Thank you for dialing in. There's quite a lot of people on this call, and I think from the proposed attendance list, there's quite a lot of different levels of people from seniority right down to junior people. So the proposal is to cover a variety of topics from a basic to a more detailed level. The panellists are me, Tom Hall. I'm National Head of Strategic Land at Shoesmiths, national remit, but I base myself out of Sheffield. I am actually in the office today, which is a joy. Your panellists are David Goy, who's a principal associate in the real estate team dealing with core real estate, and he'll give you an overview of PPAs, options, potential traps, what to be wary of, and what landowners may look for. Anna Cartledge is a partner in our planning team. She'll cover issues relating to planning and land delivery for strategic sites. And Dan Kennedy, a partner in our tax team, is going to discuss the headline tax issues that impact on land promotion and delivery. And having seen his speech before, I can promise you that it is a very interesting tax talk. It is not a boring, dry tax talk. So please make sure you stick around for Dan at the end of this. We do have a short period at the end for question and answers, so please use the Q&A function on the bottom right throughout the session to lodge your questions with us, and then we'll try and take them, or as many as we can, at the end of the session. We've already had a number of questions in from panelists before, from delegates before today, including one which I think is a nice way to kick off, which was, how does the panel see strategic land playing a role in bringing our industry out of deadlock and economic recession? And my personal view is that it's very clear that house building, and house building is the ultimate end goal of strategic land, is the key driver, if not the single key driver, of the economy. New house building contributes significantly, creating on most accounts 3.1 direct jobs for every new house built. The latest figures that were available suggested that there was £12 billion annually spent on suppliers, 90% of which stayed in the UK. And when you look at those figures, you can see that that's a huge economic driver. Not only do new homes create those direct drivers, they also feed the secondary market. So it's critical that we as an industry and a sector get house building driving, taking forward deliverable sites. Taking the house building level up to the government's preferred aim of £300,000 a year would add around 100,000 jobs to the economy. So it really is critical that we in this sector get back on our feet and do everything we can to move forwards. We need to keep on working hard together to locate and then deliver those sites. And as an industry, we need to make our voices heard as to what we actually do, and that is creating sites, making them viable, cleaning them up, delivering them, so that house builders have oven-ready sites ready to go to hit those 300,000 houses per annum. We now have a government which seems to be talking the talk about building. Whether that actually flows through is to be seen, but we as an industry need to ensure we keep making the message about infrastructure, about delivery, making sure the government follows through on its promises. And it's critical that the levelling up will only happen when we make our voice heard. So with that, I'll hand over to David for his session, but please do use the question and answer throughout, and we will try and pick them up at the end. Thank you.
Thanks, Tom. My name's David Goy, Principal Associate in the real estate team here at Shoesmiths. I'm going to talk to you today about planning promotion agreements, options, and potential traps for promoters. The reason for picking this topic is they're probably the two forms of agreement that are most commonly used, where a promoter is either piecing together a larger strategic development site or looking to promote standalone sites. Both of those agreements give the promoter an interest in the development site to allow them to go on and pursue planning, but obviously with that interest comes a significant investment on the part of the promoter, so it's really important to be aware of the potential traps. Most of this talk is from the perspective of the promoter, but they're also obviously conversely all points that are relevant to a landowner. They're all points that a well-advised promoter or landowner is likely to raise. So what are they? Don't wish to tell you what you already know, but I'm conscious there's probably a range of experience of these agreements, so I will touch on it just briefly. Planning promotion agreement allows the promoters to go away to promote the site for planning. Hopefully it then obtains planning and then will sell the site on the open market, generally to a third party, and that's a significant difference from an option agreement where the promoter would generally acquire title to the site itself. On a sale, promoter is going to charge a percentage fee of sale proceeds and usually get back all of the costs that it's spent in promoting the site. Sometimes you have a composite percentage return, which includes all of the costs. Different promoters do it slightly differently. Advantages of promotion agreements. The interest of landowner and promoter are closely aligned because it's in both parties' interests to achieve the highest price possible for the site. They're often very collaborative agreements. The landowner will generally have quite a bit of input at different stages of the promotion. And also, a third advantage, there's no property interest transferred to the promoter, and there can be lots of practical and tax reasons why a promoter would never want to own the site. Option agreements, on the other hand, allow the promoter to call for a transfer of the property to it, legal title to the site to the promoter, either at any time or after the occurrence of a certain event. That could be at a fixed price, or probably more commonly based on a percentage of open market value. And where you've got an open market value calculation, your option's almost certainly going to be conditional on planning, because that'll have the effect, obviously, of pushing the price up significantly. So that's how the landowner makes its return. Options can be more complex, where they include promotion type obligations, for example, to maximize planning, but they are often much simpler documents to promotion agreements. You've always got a conflict in an option on the open market value calculation, because it's going to be in the landowner's interest to maximize open market value, and it's going to be in the promoter's interest to minimize it, so it buys at the cheapest price or lowest price possible. The advantages of an option, they give a property interest to the promoter, and that can be what the promoter is after, particularly if it's looking to piece together a much larger development site. It might make more sense for the owner to actually take full control of parcels of land by acquiring legal title. They can be put in place pre or post planning, so if you're looking at a much longer term strategic development, then it might make sense for parcels to be added to the promoter's ownership before you've actually gone on to pursue planning. And as mentioned, they're often simpler documents. They're often a lot shorter than promotion agreements, and so they can be quicker to negotiate and put in place. So which to use when? It's always going to be case specific, but some of the questions that you're always going to ask: how much input does the landowner actually want? The promoter is, after all, the expert here, and the landowner might not be that interested at inputting at various stages. So maybe a promotion agreement isn't what the landowner wants. What are the short, medium and long-term aims of the development? Does the promoter want to acquire the site as a stepping stone? So sometimes an option agreement might be the way to go. We find that the closer a site is to a consent, the more likely it is that a landowner is going to push for a promotion agreement, because the sharing of proceeds procedure is far more transparent, and you avoid the potential conflict of an open market value calculation. Sometimes see a combination of promotions and options, particularly where the promoter wears a developer hat as well, or where you've got a JV between a promoter and a developer. So sometimes there is a combined approach. So I'm going to move on to talking about potential traps, and for that I'm going to focus on promotion agreements, because invariably they involve more landowner input, which is great, often for getting landowners on board, but wherever you see control, there is a greater risk of the parties falling out and of the promoter ultimately not being able to realise its investment in the site by achieving a sale. So obviously our job is to advise on those risks and come up with strategies to mitigate the risk. Most of the points that I'm going to touch on would also apply to options where you've got a more detailed option that includes promotion obligations on the part of the promoter. When I'm talking about control, generally I'm talking about where the landowner might require steps to have its consent or approval. That might be of specific documents or of strategies, and then also consideration of timings for provision of that consent or approval. It might be from the promoter's perspective that certain elements of the promotion are particularly time sensitive, so you're always going to want to consider how long has the owner actually got to reply. Should you maybe think about including deemed approval processes, so that the promoter's got a bit of certainty as to when it's going to hear back and can crack on with the promotion. As a general principle, we find that if a landowner is going to have a degree of control on the promotion, then the earlier on in the process, generally the better. And that's for two key reasons, really. The first is that it sets the scene for the promotion, and the promoter can sometimes use that to its advantage. If the parties are aligned very early on and the promotion then follows that course, then the promoter can often argue that provided that the eventual permission and the sale follow that agreed strategy, that the landowner doesn't really need any input later down the line. The second key reason is the more practical point, that there's far less investment in the site at that stage from the promoter. So if you're going to fall out with the landowner, then far better to do that early when you haven't spent hundreds of thousands, sometimes millions of pounds in the promotion. So stages for control, there's a number listed on the slide: planning strategy and the application. Two things that happen fairly early on in the promotion. The planning strategy might be agreed as part of the heads of terms, might be a document that is put in place at the same time as the planning promotion agreement. So strategy and application might be two areas that the promoter feels a little more comfortable in ceding a degree of control. Planning permission and the 106 agreement, should the landowner approve those, that is often required, and it can seem fairly logical given that the landowner is going to benefit from the lion's share of eventual sale proceeds. But remember, the promoter is the expert, so should they not be determining whether or not the permission that they've obtained is the best that could be reasonably obtained, considering all the factors, planning policy, etc. What if you can say that both of those documents are in line with the planning strategy and the owner has approved the planning strategy? So should they then be automatically acceptable? Is your planning strategy actually detailed enough in order to make that assessment? And what happens if the parties disagree that they're in line with the strategy? What do you do then? They're all points really that you should be documenting in as much detail as you can. The important principle, I think, if you are allowing an owner to input on the permission and planning agreement, is that you frame the question of when those are going to be acceptable as specifically as you possibly can, so that the promoter's got a degree of certainty. Selection of purchaser, you're often going to go generally with the highest price, given that you're going to be sharing in the sale proceeds. Is that an aggregate purchase price, or is payment structure important? There might be good practical reasons for staggering or tax reasons for staggering payments on a deferred basis over subsequent financial periods. Does your agreement set out any provision for that? Drafting the sale contract and actually handling the transaction. Promoter will often see that its lawyers are an important part of the promotion process, just in the same way that it will appoint its own consultants to undertake the promotion. It's also going to want to use its lawyers to handle the sale. You do sometimes see a bit of conflict there, but there can be very good reasons for promoters' lawyers acting. They are likely to have knowledge of what's going to be acceptable to house builders, how to structure, so that can help smooth the process of actually achieving a sale. The next slide, I've mentioned preserving development of landowners' retained land. And what I'm referring to here is where the landowner has a much larger landholding, or a larger landholding than just the promotion site. The site that you're selling might potentially form a gateway to landowners' retained land in terms of access and services. Those might need to be brought through the site that's being promoted and sold. And there are a range of steps that can be taken to preserve that development potential. But the key question is always going to be, is this retained land subject to the promotion agreement, or is it not? And if it isn't, then the promoter is not going to have any interest in that retained land, and so it doesn't have any interest in taking substantial steps to ensure that development potential is preserved. In terms of the extent of steps, at one end of the scale, you've got reservation of rights to lay services and to make connections. So these are legal rights rather than practical ones. And then at the other end of the scale, you've got the practical steps. So obliging the purchaser of the promotion site to put in particular access corridors and services and potentially upsizing capacity. All steps that obviously have an effect on what the buyer is going to be willing to pay for the site. And so if the promoter doesn't have an interest in the retained land, it's not going to want to be imposing those sorts of obligations, because it's going to have the effect of depressing the purchase price payable. Really important that the promotion agreement is clear on what both parties want there, particularly where the retained land isn't subject to the promotion agreement, because you stand a much greater chance of there being a degree of tension between the parties, and you wouldn't want that to be a sticking point when you get to the point of sale. Termination clauses, commonly included in lots of commercial contracts, and promotion agreements aren't any exception to that. These are clauses that are generally exercised by the landowner if the promoter's in breach, because the promoter is picking up the vast majority of obligations under a promotion agreement. So these are clauses that work in the landowner's favour. Again, they might seem entirely reasonable and fair, but clearly it's a very drastic remedy for a landowner to bring a promotion agreement to an end, and it has the effect, if successfully exercised, of completely wiping out the promoter's investment in the site. If you are considering including a termination provision and the landowners may be pushing for one, I think you've probably got two risks in particular that you've got to be aware of. The first is that the risk of being in breach is sometimes far more common or general than you might expect. So what if you don't give, as a promoter, you don't give a progress update within the timing that you say you're going to, or you don't invite the landowner to a particular meeting, maybe with the planning authority, maybe this is something that's happened at very short notice and you just haven't had the opportunity to invite the landowner, or if you miss any other time frame, should those be scenarios that allow the landowner to terminate. And the second key risk is the potential for the landowner to behave unscrupulously. So it's taking a sort of a sceptical view about whether that might happen, simply to avoid having to split sale proceeds with the promoter. Always important to remember that your landowner might change over the course of the promotion. So the party to the promotion agreement, they might not be the landowner throughout the promotion, because most agreements will allow landowners to transfer to a third party, subject to the third party agreeing to comply with the promotion agreement, but the third party might have very different views for the promotion and what is possible to be achieved. When you're considering that risk of, and hopefully we don't see it very frequently in practice at all, but when you're considering that risk, you're going to want to look at the sort of incentives that a landowner might have for terminating. How easy is it for them to say, thanks promoter for bringing the site to this stage, but we'll take it from here, we'll use our own agents to market and sell the site. So you need to look at what sort of controls have been handed over. How easy is it for the landowner to carry on the planning application? Was it made in joint names? On termination, does the promoter maybe have to hand over copyright or license in the various reports that will have been produced? Did he potentially even jointly appoint the professional team? And those might all be controls that have been handed over to the landowner, and promoter might feel comfortable with that. But when you view those then in the context of a termination, particularly a broad termination right, you might look at them far more sceptically. It's also important to consider the types of breach that would allow a landowner to exercise the termination right. Should that be any breach? I'd argue no, because that could be very, very broad. How about material or substantial breaches? You often see that terminology, and that's because those are words that have a meaning attributed to them through case law. So you do have a bit of a greater degree of certainty as to what sorts of breaches would constitute material and substantial. Could you maybe restrict termination to breach of specified obligations? That's a bit tricky, because it's really hard to sort of crystal ball gaze and think about all the potential breaches that there might be. Maybe potential obligations that wouldn't constitute breaches that would allow the landowner to terminate, particularly if the promoter is a little bit reticent in agreeing particular obligations because they think that they might be tricky to comply with. Maybe you could carve out certain of those obligations from allowing the landowner to terminate. I think wherever you end up, you need to ensure there is a clear process for the landowner notifying the promoter of an alleged breach, and also provide the promoter with the opportunity to remedy. Non-compete clauses. They're often included in promotion agreements, and they can seem entirely logical, and they often are. As a landowner, if your promoter is saying, I'm going to promote your site to the best of our ability, you don't want them promoting a competing site just down the road. But important to consider, how much should a promoter's hands actually be tied in the future? The planning and site availability landscape might change significantly, particularly where you've got a much longer term promotion agreement that could look years, 10 years, 15 years down the line. The position might be very, very different. So what might be said to compete today might not compete down the line. You're always going to want to look at what type of developments would be said to compete. Should those be directly analogous sites, or should it be broader than that? And also the location of those potentially competing sites. If you're defining location by reference to particular local authority or settlement boundary, might those change over the course of the promotion? Quite possibly would do. Should those changing boundaries, should they be taken into account at the point of deciding whether or not a site is competing? Term also, so the period for which the non-compete applies, should that run for all of the agreement, or should it run just to the point that planning is obtained? Fairly strong argument that it should just run to the point that planning is obtained, but you need to consider that. Always useful as well to be able to build in a degree of flexibility, so that if what would look to be a competing development on the face of it, if there are good reasons why it doesn't actually compete, then always useful to be able to have a mechanism to facilitate a discussion between the promoter and the landowner to agree otherwise. Lastly, as Tom mentioned, we had a number of questions submitted by delegates before today's session, which was great. And one of those questions was directly related to what I've talked about this morning. So what I'm going to do is read out that question and then try and provide an answer. Question is, what is the current market practice around tax suspension, mitigation and freezer clauses in promotion agreements, and what are the pitfalls? Owners' agents are worried about development taxes being imposed. Well, firstly, what are they? They allow landowners to pause the marketing and sale process if the sale proceeds that they will receive would be taxed above a certain threshold. So they allow the landowner that degree of comfort. I'm going to look to answer the question simply from the sort of pitfalls and points that you would look at in drafting your planning promotion agreement. And then my colleague Dan Kennedy, a little later on, will input on the practical application of those clauses and the potential difficulties associated with actually interpreting them and applying them. I think you've always got three key points to bear in mind. First is setting the percentage threshold at a sensible level. So this is the percentage above which landowner can invoke the freezer. You want to make sure that there is sufficient headroom between the existing level of tax and the threshold, so that it isn't just a small fluctuation that would allow the owner to invoke the freezer. Second is, what is the applicable tax? It's usually going to be capital gains tax, but be absolutely clear on what the type of tax is. And then thirdly, term. Landowners will often want it to be indefinite, so they can't be obliged to sell if they're going to be taxed at a certain rate. From a promoter's perspective, that's very rarely going to be acceptable, because it could have the effect of putting on pause for a significant period, or even indefinitely, its ability to make a sale and to realise investment in the site. So hopefully, I'm conscious of time, hopefully that was a fairly useful brief run through of the potential traps, how to navigate them to mitigate the risks. And the central message is always try to ensure as best as you can that whatever document it is that you put in place gives as much detail of the party's intention at the outset to hopefully avoid a conflict arising altogether. Thank you.
Thanks, David. Over to Anna, if Anna's system is working. Give us a wave if you can hear us, Anna.
Hello, can you hear me?
Hi, I can. Perfect. I'll hand over to you now, Anna.
Brilliant, thank you. So good morning, everyone. My name's Anna Cartledge. I'm a partner and I specialise in planning law. So I've been involved in strategic land for about 15 years now. So very much enjoy getting involved with it. So if we move on to my first slide, it's starting at the beginning of the process, really, regarding site allocation. So this is the process for establishing the principle of a use through the local plan process. So it basically establishes that a use is acceptable. So whether that's residential or whether that's an employment use, it can be really worthwhile engaging in terms of the local planning process, because that establishes that the idea is acceptable. You still have to go through the planning application process, but this stands you in good stead. I know that some local planning authorities are fairly slow in terms of bringing their local plans forward. It looks like the government are going to impose a date by which everybody has to have a local plan, an up-to-date local plan in place, and the date of 2023 has been mentioned. I'm not sure that that's going to hold steady now, given COVID-19. We don't know when the white paper is going to be out, so we'll know a lot more when that comes out. So the one thing I would say is don't discount neighbourhood plans, because they can allocate sites as well. So it can be worth engaging in respect of neighbourhood plans. I think there's an acceptance amongst local communities that housing has to go somewhere, albeit that it's not universally popular, but it has to go somewhere, and therefore some local communities will want to engage in terms of neighbourhood planning. So you might be able to get probably a slightly smaller allocation, but you might be able to get your residential allocations through neighbourhood plans too. It's a bit, it's quite tactical in terms of looking at the local planning process and looking at when you put your application in and when you want your application determined, because the last thing that you want is for there to be some question over prematurity in terms of whether you put your application in too early, i.e. you put it in when the local plan was still proceeding, and you should have waited until that local plan had been adopted. I think prematurity in terms of planning applications, it was in vogue in terms of decisions that were challenged a couple of years ago. There's not quite the same number of challenges on those grounds anymore. So, but it's still a point to be wary of. You might also have part of your site in the green belt, and so you'd probably want to be engaged in terms of any greenbelt release programme that local planning authority is going through. I have to say, greenbelt release under this government is not particularly championed, so there hasn't been meaningful greenbelt release to date. I can't see there being a lot of it either, personally, but we'll see. When you're looking at site allocations, the one thing that you need to do is look at deliverability. And it's really important to prove that the site is deliverable. And usually the way that you do that is by undertaking something called a sustainability appraisal. And that looks at various factors in terms of the site, and sort of grades it in terms of deliverability. So it might be, is it constrained by a railway line? Is it accessible in terms of public transport? Is it connected to existing footpath networks? All that sort of thing will build up your sustainability appraisal. So there's specialist consultants who will get involved in that. But in terms of bolstering your chances of getting a site allocation, then the best thing that you can do is start to look at sustainability appraisals. So it's really important to consider whether there's any large-scale infrastructure requirements, and I'll come on to community infrastructure levy a little bit later on. And also whether there's any third-party reliance. It's much better to know if you need somebody else in order to deliver the site at a very early stage, because the last thing that you want to do is put your application in and then find yourself in a ransom position. So it's really, really important to know the site and to know the title inside out, so you don't inadvertently end up in a difficult position later on. Anybody with an interest in land is going to have to be a signatory to your Section 106 agreement. And the one that we sometimes come up against is where you've got somebody with the benefit of an old charge, but that charge is registered on the title, and the chargee ultimately has step-in rights. So anybody that has step-in rights in terms of the land will need to be a signature to the 106, because effectively the authority wants to know that they agree and will be bound by the 106. So Lastly, in terms of the site allocation process, I've briefly touched on it, is you need to know what the position is in terms of SIL, and also where there isn't a charging schedule in place, you'll want to know when a charging schedule is imminent. So my next slide is around development constraints. Again, this will input into your sustainability appraisal in terms of any applicable land designations. So you want to know if part of your or all of your site is in the greenbelt. There are some forms of development that will be compatible with greenbelt use. So you might want to put your SUDs on the greenbelt land. You can design around it. You might have land in SSI, SACs. All sorts of things, but you can deal with them, but you just need to know what you need to include within your environmental statement if one is required. You might require the input of a number of agencies in delivering the consent. For example, the Highways Authority. So it's quite common that the County Council is separate to the Planning Authority, and in reality, they don't always speak to each other, and sometimes the highways agreements, if required, can be delayed, and they should really be quite straightforward, because the County Council, the time that they should be making representations is at the planning application stage. So it's really worthwhile engaging not only with the Planning Authority but also with the Highways Authority as well, so that they're up to date in terms of your project programme. There might be other bodies. There might be Highways England, where you've got trunk roads, TfL, if it's development in London. And then you need to be conscious as well about bodies like Historic England, where there are heritage assets. HS2, is there any potential for HS2 to impact on your development? It's really worth checking the mapping on the HS2 website, because I think in terms of local searches, it can sometimes be quite difficult to work out exactly where the constraints line is. So it's really worthwhile doing that. You also need to know whether any third-party land and rights is required, and I've put common problems and ransoms can include Network Rail land. And the reason that I've put that is because I recently did an appeal where Network Rail were quite difficult, so that's why I've singled them out. Any common land or TVG issues, so town and village greens. The other one to add in there is public rights of way. Town and village greens are less common now because it's much more difficult to make an application. That's another reason actually why it's a good idea to get an allocation in a local plan, because that will prevent an application being made for a town and village green, full stop. So then you don't have to worry about it. Public rights of way, if they're not on the definitive map, you need to have a think about whether it is worth objecting to any application if one is made, or whether it is better to accept the application and then apply to stop it up and divert it, because that can actually be quicker in terms of the development. My next point is that you will come up against curveballs when dealing with strategic land. So when I was involved in North Stowe, there was an unexploded ordnance because it was an airbase. We dug up Raymond's when I was involved in a project in Hereford. So I like to think of strategic land as an exam question, because it throws everything at you, and then you have to sort of work it all out and work out how things are going to come out in terms of the overall timetable. So another big one to flag is biodiversity net gain. So this is coming in under the Environment Bill. We're expecting it to be enacted later in the year. We're not entirely sure when the provisions around biodiversity net gain will be commenced, but it's going from the position of developments causing no harm, so you like that in terms of your scales, to developments actually having to do that, and they have to evidence that there is biodiversity improvement as a result of the development. And the difficulty with this is that the better the biodiversity value of the land to start, the more difficult it is to then evidence improvement. So you really need to be thinking about this if you're at if your development site is in its infancy, because it is coming in, and some local authorities have already got equivalent provisions within their local planning policies. So we've done a webinar on that, by the way, which is on the website if you want to have a look at that. So the next one is a slide in terms of Section 106 agreements and the kind of thing you need to be looking out for. So in terms of heads of terms, just be careful that you don't make these so broad that it then becomes a matter for interpretation later on. You need to know what you've agreed, because then that will plug into your viability. Ensure that your title is free from any encumbrances, and this was the point that I made earlier around, do you have anybody with step-in rights in respect of the land? So it's really worthwhile doing a really thorough title check right at the start. You also need to be wary of any restrictive covenants. So there may be a restrictive covenant that prevents the placement of residential units on the site. You know, I've seen them before, or various other covenants that make it difficult. So deal with your covenants at an early stage. As the matter progresses, it's quite important that the committee report should reflect the heads of terms that you have submitted in respect of the Section 106 agreement. This isn't always the case, and there's recent case law on it where a decision got quashed because the committee report didn't reflect what had been agreed. And it's absolutely key in terms of your 106 that you structure it so that you enable it to come forward in the way that you envisage it to. So on a residential site, if you're a house builder and you're building out all of the site, then this point becomes less important because you have control over the site-wide occupation numbers. However, if you're promoting a residential development that you're then going to parcel up in phases and sell off those phases one by one, you've got to structure the 106 to enable those phases to come forward individually. So you don't want site-wide occupational triggers. Basically, you want the phases to be able to come forward. Otherwise, it's quite difficult having to deal with parcelling it up. So in terms of common issues and the detailed drafting, common issues, viability usually comes up when you're dealing with strategic land. So typical points are, how are viability reviews structured? What's your baseline point? It's really important to establish what your baseline is. What do you actually want to go into your Section 106? Because after all, these are public documents. So that's something to be mindful of, because then that has a potential impact on the values. And in terms of the viability review, you don't want to make it unattractive for future plot purchasers, but you need to also ensure that there's sufficient certainty for them to be able to price up. So in terms of the structure of the agreement and the thresholds, this becomes particularly important for the big ticket contributions, which tend to be education and highways, so the county council contributions. You need to structure those quite carefully. Obviously, the preference of the county council would usually be for the highways contributions to be made early on, obviously, because you need access improved as the site is built out. But that's not always viable, so you need to have those discussions. I know the government said that they're putting billions into infrastructure, but the detail around that at the moment is quite sketchy. I've covered the point about the future sales, I think, so I will crack on to the next slide. I'm aware of time. So another common issue in terms of detailed drafting of Section 106 agreement is the management company provisions and how you deal with service charges. So who's going to own the land? What provisions are there to safeguard the land's ongoing maintenance, particularly once you're finished and once you're off site? What happens if there's default on the part of the management company? You need to be mindful of destination parks against different other types of open space, so leaps or neeps, and also what's happening with your suds. This takes me on to one of the questions actually that we got sent, which is, what are common issues that you come across when establishing long-term stewardship models for green infrastructure and community assets? And I think the common issues are very much around, how do you secure the stewardship? What are the timeframes? You know, how do you can't really, from the planning authority side, you can't really insist on it in perpetuity. So how do you structure it in terms of the time frame? What do you do in the event of default by the management company? You know, it's a difficult one once everything's been built out, but does the authority actually want to step in right? Is there any inherent value in the land in the event that they do step in? You also when you're talking about this type of infrastructure, which includes SANGs, and this will be applicable in terms of biodiversity net gain as well. You need to think about the practicalities, because it's really rare that the exact green space is going to meet the amount needed in planning terms. You know, there is likely to be an excess. And we're seeing more and more commercial SANGs now, whereby developers are able to take advantage of the excess SANG being provided, and what they'll do is they will make a payment to the SANG owner. So I think practicalities is another point to think about. So moving on, just touching on community infrastructure levy, I'm always quite surprised by how little people engage when community infrastructure levy is being consulted on. It's quite rare, actually, for appearances at the examinations, and which I think it is actually worth engaging with it, because it's quite important and it can be quite a big development cost. So the Reg 123 list will list out the chunky items of infrastructure that the planning authority will fund by way of SIL. And the way that SIL works is that you can have different rates associated with different land uses, and also with different zones of development being provided. So at the heart of the evidence base when they're setting this, there needs to be an appropriate balance between the need for infrastructure and also the effect on viability. And I think going forward, that's going to become more and more important, because as we keep being told, we're going to build our way out of whatever Britain looks like post COVID-19 and lockdown. So in conclusion, I think there is no such thing as the perfect site. You will inevitably, however much you prepare, you will encounter curveballs, as I like to call them. But it's key that you do as much work as you can at the start to identify site constraints. And that's me, really. That's all I wanted to say.
Thanks very much, Anna. There have been a couple of questions popping up, and Andrew Holden's asked, thinking about the government putting in a deadline for plans, is an up-to-date local plan an advantage or a disadvantage from a developer point of view? I think the sort of trite answer to that is it depends what land the developer controls. If you don't have an up-to-date local plan and you've got a promoter stroke developer wanting to bring forward a site, then it is an advantage to not have a local plan, because you can challenge it and you can hopefully bring forward land supply arguments to take forward your site. But then the converse of that is, if you're a developer sitting on an allocated site in a robust local plan, then it's clearly an advantage for that local plan to be up to date and in place, because then you can crack on quite comfortably with development, knowing that the local plan's in place and the local objections have hopefully been flushed out and your scheme is supported. So I think it creates opportunities and threats, both of them. And I know that's an answer sitting very firmly on the fence, but there are advantages to certain people depending on what land they hold, I think. I don't know whether Anna or Dan wants to chip in on that.
I completely agree with that. I mean, so planning's so political, isn't it? And it depends on the temperature of the local planning authority, depends on the officers and how warm they are in respect of the site. And I think it's something that needs to be looked at on a site-by-site basis. And I know that is sitting on the fence, but the reality is it's to do with whether realistically there is appetite for your site to come forward in respect of the planning authority. I mean, the one thing I would say is that in my experience, officers are receptive if you want to have an initial chat. So don't be scared about going to see them. But if the mood is very much anti the site, then not having a plan in place, as Tom said, would be advantageous in that circumstance.
Thanks. Dan, I'll hand over to Dan, and you can scare us all with tax issues on land promotion agreements. Every time I hear it, I leave feeling very scared. So hopefully you can make me smile. Cheers, Dan.
Hi, thanks, Tom. Hi all. My name's Dan Kennedy. I'm a partner in the tax team at Shoesmiths, and I spend most of my time working on real estate transactions. After Tom's big build-up, I'm worried about how interesting this tax session is going to be, given that it is in fact tax. But I have to say that strategic land arrangements are some of the more challenging transactions we look at with lots of moving parts. So as with Anna, there's definitely a case that it feels like an exam question when you're considering all the tax issues at stake. Unlike David, I'm going to look at this more from the landowner's point of view rather than the promoters, because I think the more interesting tax issues sit on the landowner's side of the fence. But promoters and developers need to be aware of the issues facing landowners to try and kind of find the correct path through the transactions. So this slide just summarises very high level the key tax issues we have to consider. Stamp duty land tax is always a cost on real estate transactions, and given that we've got multiple parties here, the landowner, the promoter, the developer, possibly adjacent landowners as well, we're always keen to try and avoid any double charges to SDLT and just minimise the number of times SDLT is charged in relation to the same land. And a key driver we see in these types of arrangements as well is the unfortunate position at law at the moment that SDLT is payable on the VAT. So if you pay a purchase price for some land, you pay SDLT on that. And if you have to pay VAT in addition to the purchase price, then you also pay SDLT on that VAT element as well. And that can be a cost which adds up, broadly 1% of the purchase price as a cost. Which brings us to VAT. VAT is a key issue we have to consider from the landowner's perspective, given that they're going to be incurring costs in relation to the sale, but also given that they're likely to face some significant pressure not to charge VAT on the sale of the land. As a starting point, the landowner will have some flexibility as to whether it wants to charge VAT or not on the sale of the land. But coming to the other side of the transaction, the developer will be quite keen not to pay VAT, both so it doesn't have to pay out 20% of the purchase price in addition on day one and wait for that to be recovered from HMRC, albeit that they should be in a position to recover that VAT. But that's also increasing the developer's SDLT cost, and that would, from the developer's perspective, they'd like that to be avoided if possible. So there's very often a discussion to be had around what's the additional SDLT cost if the landowner charges VAT on the sale versus what are the irrecoverable VAT costs for the landowner if it doesn't charge VAT. And that will very much come down to modelling and the numbers in play given the transaction. Another key issue we will often see need to be addressed during the arrangements is capital gains tax for the landowner. Very often the landowner will have held the land for some time, maybe they're farmers that have been holding the land as trading or for the purposes of their farming trade, and therefore they're seeking entrepreneurs relief on sale. So that capital gains tax treatment, given the lower rates of capital gains tax versus income tax, is going to be very important to try and preserve for the landowner. But as we'll come on to, there is significant risks of trading income arising for the landowner with much more significant tax charges associated to them. And then finally, very often we'll see situations where landowners are pooling their land with other adjacent landowners to deliver a much bigger site. And that creates a whole new level of tax issues that need to rest on top of the basic ones that we're going to discuss. So I'm going to talk very briefly about potential structures we can adopt in those scenarios. Okay, it's going to be a bit of a whistle-stop tour given where we are in time, but adopting the approach that David adopted, I'm going to look at, first of all, your planning promotion agreement arrangement, and then go on to the option arrangement and contrast the SDLT and VAT treatment of the two. The important point to note on the planning promotion agreement is that the promoter for VAT purposes is making a supply of services to the landowner. The promoter doesn't have an interest in the land, so all it is doing in return for its payment at the end, its profit share payment at the end, is supplying the services to the landowner of going off seeking planning, negotiating with a buyer and potentially preparing the site in other ways. So that's a supply being made by the promoter. If we flick the slide on, And again, sorry, Tom. That contrasts with the landowner eventually making the sale of land to the developer. It's important to note that for VAT purposes, the sale of land is by the landowner to the developer, and it's not a sale by the promoter, notwithstanding that the promoter's been key to the negotiations and will often be party to that contract. For VAT purposes, it's clear that the supply of land is travelling from the landowner to the developer. So the question becomes, sorry, back one, Tom. The question becomes, should the landowner charge VAT on the sale of land? The developer will say, no, I don't want to pay VAT. I've got a funding and an SDLT cost associated. But from the landowner's perspective, under the planning promotion agreement, they're in a situation where they're not going to be able to recover the VAT on their costs of doing the deal if they don't charge VAT. So that will mean the VAT on the legal costs, possibly the agent's costs, but most significantly, the promotion fee payable to the promoter. That's going to be the key significant cost of the landowner, which may well push it into opting to tax the land. And just on a practical point here, I think where we see this becoming a real bone of contention is where the landowner hasn't taken advice up front, and perhaps the promoter hasn't really held its hand from the outset around this issue. And where we really see issues is that we're coming to the last gasps of negotiation on the sale of the land to the developer, and then the landowner late in the day realizes it's going to be paying the promotion fee to the promoter plus VAT, and it's not going to be able to recover that VAT, with that VAT being an additional 20% cost to the landowner. We're always keen to try and flush this out at the earliest opportunity to see the approach that should be adopted and whether the landowner should be opting to tax the land. In the worst case scenario, we see situations where the promoter's kind of snookered the landowner. They've included provisions in the promotion agreement that prevent the landowner from opting to tax, which can really sour things between the promoter and the landowner when we come to discuss the negotiations with the buyer. Okay, moving on. I'll flick on again, Tom, please. The alternative, as David mentioned, is the kind of option agreement situation where the landowner, instead of entering into a promotion agreement for services, the promoter takes an interest in the land. So it could be a sale contract, a conditional sale contract, or an option agreement. And then the promoter will look to subsell the land to the eventual developer. This can be done in such a way that no VAT arises. And the important point that happens in this instance is that the promoter's share that it takes out of the deal is by way of profit from a sale of land rather than by way of a fee for its services. And therefore, for VAT purposes, provided the landowner and the promoter don't opt to tax the land, there's no VAT arising on the promoter's fee, which would get you to a pretty good place if you're the developer, because you're paying the same price without VAT and your SDLT is lower. We've removed the VAT on the promoter's profit share, which is really good news, I think, from a VAT perspective, but we can't entirely remove the irrecoverable VAT if we don't opt to tax the land. So in this instance, the landowner will still suffer irrecoverable VAT on the legal costs and perhaps agents' fees, any other costs it's got on the deal. And the promoter will equally not be able to recover VAT on its legal fees, and potentially more materially, if it's incurred really significant planning fees or fees in preparing the site for sale, then that VAT will be irrecoverable, which means that might push the promoter into a situation where it wants to opt to tax the land. So those are the two main kind of headline approaches we see. We also see a couple of alternatives, kind of variations on a theme, really. The assignment or novation of the option agreement would involve the promoter taking its profit share by way of an assignment or novation of the option agreement. The idea being that the promoter assigns the option and then the buyer acquires the land directly from the landowner. This is kind of a hybrid approach which enables the the landowner not to opt to tax because it's not suffering irrecoverable VAT on the promoter's fee, because the promoter's fee is being paid by the developer directly to the promoter. Therefore, the landowner doesn't bear that cost, and therefore the only irrecoverable VAT at stake from its perspective is probably the VAT on its legal costs. The promoter will look to charge VAT on the assignment fee. That's its profit share. It charges VAT on that, so the buyer will have some VAT to pay on the deal, and therefore the SDLT cost will go up slightly. But maybe we get to a situation where it's kind of a middle ground, where the promoter can recover all its VAT. The buyer has a slightly increased VAT and SDLT cost, but overall that might be a middle path that can be trodden. Finally, another alternative approach is for the promoter to take an interest in the land up front, with the idea being that if the promoter's bought into the land up front, it's going to receive its promotion share or its profit share by way of sale proceeds from the land when the land is sold jointly by the promoter and the landowner in the future. This can work again. There are a few more tax issues to work through, given that the landowner will make an upfront part disposal of the land, so there's a potential capital gains tax liability there. Similarly, the promoter's buying into the land, so it could have an SDLT cost, although how material these upfront tax costs are will depend on the value of the land, and presumably the value of the land at the time this is all implemented is relatively low because it's pre-planning and pre any other steps needed to bring the site forward for sale. So yeah, a very brief overview of that joint ownership, and as my bullet point says, there's various issues to work through. Conscious of time, I'll rattle through the next couple of slides. Capital gains tax for landowners is going to be key. Assuming they've owned the property for some time, they're going to expect the property, when they sell it, to be taxed as an investment or as a fixed asset, such that capital gains tax rates apply, which will be 20% generally, although that could be 28% if we've got residential property on the land, or conversely, if we've got residential property on the land that is the landowner's home, then we might get full relief to the extent of the home. So there's an interesting question there as to how big the home should be considered when we've also got other land and farmland with it. And as mentioned previously, there's the potential for entrepreneurs relief, and historically we've seen entrepreneurs relief being a real key driving tax factor, with farmers in particular looking to sell land after they've ceased farming the land and benefiting from entrepreneurs relief. That might be less of an issue now that the lifetime limit for entrepreneurs relief has been slashed from 10 million to 1 million, is likely to be less of a driving factor on these arrangements. So that's where the landowner wants to get to. It wants to pay capital gains tax. The risk is that it is subject to income tax, and that could mean for individuals tax rates of up to 45%. The risk is that the revenue looks at the arrangements and says that you have either always held the intention to sell this land as a profit, and that was your driving intention from the outset, or conversely, you've previously held the intention to hold the property as a long-term investment, but now you've converted that intention into a profit motive, and therefore we're going to tax you at income tax rates accordingly. This is a bit of a tricky question to answer. It's very fact specific, and there are numerous factors you have to consider when considering whether land is held as trading stock or capital gains tax. But as a very, very general rule, if the property has been held for some time for the purposes of a farming business or for the purposes of receiving rental income, then generally you will be looking at capital gains tax rates. And the fact that you enter into a promotion agreement, which is clearly intended to maximise your profit from sale, that of itself shouldn't remove you from the capital gains tax regime. That shouldn't of itself be a problem. Where we see bigger problems are in relation to where some works are undertaken to the land prior to sale, some physical works to change the nature of the land itself. So putting in infrastructure or services, that kind of stuff is really problematic as far as maintaining capital gains tax treatment. It's all a question of degree, of course, and as I say, there's numerous factors that need to be weighed up, but that is something to be very mindful of when you're the landowner, and should you be allowing promoters to go onto site to put in services, etc., even against the backdrop of that most likely increasing the value of the site overall. A quick word on overage, where the landowner sells the land up front and then receives an overage in the future by reference to the developer's future sale of residential dwellings, then in those instances that's always going to be income from the landowner's perspective. The overage will be taxed as income, and HMRC's stance on that is very clear. So that's something, not much we can do about that, but something that landowners need to factor in when they're kind of considering the pricing of any overage and the pricing of upfront payments. And then finally, conscious of overrunning, very quick run through kind of land pooling arrangements. So this is where we've got a landowner that comes together with other landowners to kind of promote a larger site, with the idea being that the various parties share in the proceeds in proportion to their contribution to the site. Tom, if we flick the slide on, there are three general approaches we see to this. The first one is kind of the most simple arrangement, just a simple collaboration agreement between the parties, no movement of land. Basically, I say to my neighbour, we will both share in the costs and sale proceeds from any sale of our land together. So if I sell land to a third party, I will give you part of the proceeds in proportion to our joint position, and vice versa. If you sell the land, I'll enjoy a share of that sale proceeds. That's all very simple from a kind of implementation point of view, but from a CGT point of view, it's a bit of a disaster. If the property is held by the landowners as investments and they're expecting capital gains tax treatment, then unfortunately the way that the CGT rules work is that when I sell my land, I will be taxed on the full amount of the proceeds, notwithstanding I'm not going to keep those proceeds because I'm going to pass some of them to my neighbour. I still have to pay tax on the full amount because that's the transaction that's taxed. Furthermore, I don't get a tax deduction for my payment to my neighbour, and so therefore I've suffered more tax proportionately compared to the amount of proceeds I've actually retained. Furthermore, to kind of kick us even further, the neighbour will also be taxed on receipt of my equalisation payment to him. So we've got a double taxation there that really makes this quite unviable, where the parties are fully advised of the consequences. That's the position where the neighbours are holding the properties as investments and are subject to CGT. If in fact from the outset we are accepting of the fact that we're trading in the land and that we're subject to income tax, or more likely if we're companies owning the land and we're subject to corporation tax, then actually this isn't such a bad idea. There's no double taxation, because for trading purposes we should get a tax deduction for the equalisation payment, so it actually all works its way out. Just a quick word on these types of arrangements. There's also a question mark on VAT recovery, where you are paying costs that relate to someone else's land. Should you be able to recover the VAT that's incurred in relation to someone else's land is a bit of an open question, and one that needs to be worked through on these types of arrangements. Very often the solution we'll see in scenarios where the land is held as an investment and subject to CGT is the land pooling arrangement. This is a situation where all the landowners transfer their properties into a trust held by one or two trustees who will hold the property, the overall property, on trust for each of the owners in proportion to their contribution to the trust at the outset. So the landowner has effectively swapped his interest in land, in his own land, for a proportionate interest in the whole of the site, and he'll be entitled to the proportionate sale proceeds when any part of that site is sold. Jenkins and Brown is the name given to these trusts, and that's the name of the case that gives us the tax analysis on which this all hangs. And that analysis tells us that, if done correctly, the investors that put their land into the trust do not suffer any capital gains tax when they transfer the land in, and furthermore, HMRC have confirmed subsequently that there shouldn't be any SDLT for the trustees when the land goes into the trust. So we're able to set up this trust on a tax-neutral basis, and then the investors, the landowners, are only taxed when the land is actually sold and they receive their proportionate share of the sale proceeds out of the trust. I guess my two comments on this are: implementation is absolutely key to this beneficial tax analysis. It must always be remembered that everything needs to be in proportion when the land goes into the trust, and any subsequent changes to the profit sharing ratios or addition of more land at a later date can be a real headache that can throw the tax analysis out of whack. So implementation is key. And I've also just got a certain nervousness around this. There are forever whispers that HMRC are not happy with the SDLT treatment of these arrangements, and they might look to challenge that. And I think you can, by extension, think that there's also a risk that they might challenge the capital gains tax treatment, particularly given the case law is very old and perhaps is ripe for a revisiting from HMRC. So that's something that I'm always keen to impress on parties, that there is this residual risk that they need to be aware of a potential challenge. Finally, and very quickly, there might be a compelling commercial rationale for using a joint venture vehicle in terms of simplicity. So land is transferred in to a joint venture vehicle up front, so that we've got one point of contact for the promotion and sale of the site, and that can really ease decision-making processes, etc. There are lots of tax issues to think of up here. There's upfront tax issues for the joint venture vehicle in terms of SDLT and VAT when it buys the land from, or takes a transfer of the land from the landowners. The landowners are also going to be making disposals most likely for capital gains tax, although those charges can be mitigated if the joint venture vehicle chosen is a partnership. The parties also need to be considering what will happen at the later date when the joint venture vehicle actually sells the land, because in particular where that JV vehicle is a company, we're looking at two layers of taxation, because we've got the company selling the sites to the developer and realising a profit on which tax will have to be paid by the company. But then the post-tax profits of the company then need to be distributed to the investors, and that will again be taxed in the hands of the investors, landowners, leading to two levels of taxation. But the use of a joint venture company can also be beneficial, because it can also enable the exit being the sale of the shares in the company itself. So the landowners who've got shares in the JV company sell the shares to the developer, and in that way there's no SDLT to pay on the acquisition by the developer, because the developer's not buying land, it's buying shares. So that is a benefit that needs to be factored in against the other downsides that might arise through the use of a joint venture vehicle. So Tom, that's my whistle-stop tour of the various issues that can arise. So conscious of time,
yeah, exactly. And I think there are a few questions popping up if we've got time to answer them, but I think they're more tax-related, Dan. So I think they might be, particularly the question that's just come in from George: when's the best time to land pool? I think from my perspective, I wouldn't want to be doing it early on in the development, particularly because you don't know what the scheme looks like, but the longer that you leave it and the more you get closer to a master plan designed, the more different parcels of land will be having their values allocated to them. So the idea of gross area equalisation becomes much more difficult at that point, because one party's got lots of green space and one party's got lots of valuable housing on their land. So I don't think there is an ideal time. I think it's a question of looking at the facts on your particular site and talking about what all the end goals are for all the parties. It can certainly make things a lot more difficult to land pool early from the promoter's perspective, for sure.
Yeah, I agree, Tom. I think there is a real tension here between the tax drivers normally wanting you to get the land into your arrangement as early as possible, because that's when the land is at its lowest value. So you're not crystallising these upfront tax charges without receiving third-party proceeds. So we've got dry tax charges, which are always quite unpalatable. So you want to do it as early as possible from a tax perspective, but that might not pan out very well in the long term if actually the deals have to change because the facts change in the interim.
Which they always do.
Almost always do, exactly. So you're then looking at situations where you're trying to adjust land promoting or land pooling arrangements that you've already put in place. And that can be even worse from a tax perspective because the land's gone up in value. And again, we're looking at dry tax charges that we were hoping to avoid in the first instance. So it is really a balancing act of certainty versus doing it when the value is as low as possible.
Okay, thank you very much, everybody. I'm conscious we've overrun and it is nearly lunchtime, so I'd like to thank everybody who's attended. There are a few questions that have come in about us making this available. Yes, we will make available the slides, and the webinar has been recorded, so when we email out the slides, we will put a link in that email to our website where you will be able to watch this again. All of our profiles are on the website, and I'm more than happy to take direct questions. I'm sure everybody else is as well, so as if by magic, they've popped up on the screen. If you want to drop any of us an email, any questions anytime, then that would be much welcomed. Also, we intend to roll out a series of these webinars over the next few months, touching on lots of different topics. So I appreciate today's been quite a canter through what is a very detailed subject. So if there are any things that you would like us to touch on, particularly in upcoming episodes of this, then please let us know and we'll do our best to do that. But, again, thank you very much, everybody, for coming, and thank you to all the panelists, and look forward to seeing you all in person soon. Thanks very much, everybody.